Welcome to The Explainer. Today, we're distilling some absolutely essential source material to tackle a topic that's critical for literally any finance professional operating in the region, the UAE corporate tax regime. We aren't just going to look at the broad strokes here. Now, we are zooming way in on the mechanics that actually protect your professional reputation. Because honestly, the difference between a totally smooth filing season and a massive regulatory headache, it all comes down to structure. So let's map out exactly how to safeguard your filings and, by extension, your clients.
Okay, let's dive into this compliance survival guide. We'll be hitting 4 sections today. Section 1, the cost of noncompliance. Section 2, 6 common tax mistakes. Section 3, building a defensible file. And finally, Section 4, navigating a young tax regime.
Starting right off with Section 1, the cost of noncompliance, where we really need to understand your penalty exposure.
Let's be super clear from the jump. Penalty exposure under this new regime is incredibly real, and it is strictly enforced. Take 10,000 dirhams, for example. That is the steep, flat penalty just for late registration. Basically, a very, very expensive, I forgot. But there is a lifeline you can use to protect your clients here. The Federal Tax Authority, the FTA, has offered a waiver. If an entity registers late, but they still manage to file their first corporate tax return within 7 months of the end of their first tax period, that 10,000 dirham penalty can actually be waived. This is a massive lifeline, so it is absolutely worth flagging for any client who got behind schedule.
Now, what happens if you miss the filing deadline entirely? Well, late filing penalties accrue monthly. They start at 500 dirhams per month for the first 12 months, and then they rise even higher after that for continued noncompliance. But remember, that's just on the filing side. It's totally vital to keep in mind that late payment penalties also exist, and those, they accrue as a percentage of the unpaid tax, constantly compounding the longer that balance just sits there outstanding. The math works against you very, very quickly.
So filing an incorrect return triggers an entirely separate set of penalties. But you do have a way out. Those penalties are generally reduced if you proactively submit a voluntary disclosure before the FTA spots the error themselves. Basically, self-review before an FTA audit is always the cheaper path. It quite literally pays to find your own mistakes.
Moving on to Section 2, 6 common tax mistakes, or really, where professionals go wrong.
Let's look at the specific, real-world errors that instantly trigger FTA inquiries. Mistake number 1 is treating small business relief like it's just automatic. It absolutely isn't. Failing to elect it, or on the flip side, electing it when a client actually needs to utilize loss carryforwards is a major strategic blunder. Then, mistake number 2 is honestly even more fragile. Mismanaging the free zone de minimis threshold. Just imagine this. A single mainland transaction pushes your non-qualifying revenue just past that 5% mark, and boom, you have lost your qualifying free zone person status for the entire period. Seriously, one rogue invoice can undo an entire tax strategy.
Another really dangerous trap is missing the interest deduction cap. This is especially true for highly leveraged entities that rely heavily on related party financing. If you aren't tracking those caps super closely, penalties are going to catch you right off guard. Then there's the classic documentation failure, not maintaining transfer pricing records contemporaneously. Waiting until year-end, or worse, waiting until the FTA knocks on your door, that's a total nightmare. You absolutely do not want to be scrambling to reconstruct records under intense audit pressure.
And this brilliantly illustrates our next point, the overlap trap. Treating a VAT filing and a corporate tax filing like they are the exact same exercise is a massive mistake. They might seem similar, but they are governed by entirely different rules, entirely different timings, and completely different mechanical treatments.
So why does treating them the same matter so much? Because the authority is actively cross-referencing your corporate tax filings with your VAT filings. If you report inconsistent revenue figures across the two regimes, that is quite literally one of the fastest ways to trigger an audit. It's a huge red flag.
Finally, we have the fatal error of submitting unaudited numbers when audited financials are explicitly required. If your entity's revenue crosses the 50 million dirham mark, or if you hold QFZP status, audited financials are 100% non-negotiable. Missing this completely invalidates your filing position. There's just no way around it.
All right, Section 3, building a defensible file. This is your compliance shield.
We've looked at the traps, so now it's time to play some offense. Let's define what a defensible file actually means in practice. It's a comprehensive, standing audit trail. It means you've actively re-verified eligibility, you've reconciled all your figures, and you've maintained that contemporaneous documentation we talked about. You are essentially pre-auditing your own work. That way,
If the FDA ever asks a question, the answer is already sitting right there, ready to go in the file.
To build that shield, you've got to adopt this standing checklist for every single engagement. First, confirm classification and residency at the very start of each tax period. Actually, keep in mind things often change after onboarding. Second, reconfirm free zone eligibility every single period. Third, update your transfer pricing docs the exact moment related party transactions occur. Don't wait. Fourth, reconcile your CT revenue against your VAT before you ever hit submit. And lastly, retain a crystal clear audit trail. You want to trace the journey from raw accounting profit straight through to the final taxable income figure, and cross-reference every single EMERA tax return field along the way.
And that brings us to Section 4, Navigating a Young Tax Regime and How to Stay Ahead of the Curve.
Look, everything we've discussed is critical, but we have to acknowledge one fundamental truth based on our source material. The UAE corporate tax regime is still evolving. It's young. The landscape is constantly shifting under our feet. The FTA issues new public clarifications. We see new cabinet decisions that refine how the law actually works, and we constantly have to monitor sunset provisions, like the end date for small business relief. Basically, what was perfectly compliant on last year's tax return might be totally outdated by the time you sit down to do this year's return. Because of this constant evolution, you need a strict two-step workflow. So the crucial point is, Step 1 must always precede Step 2. Build a mandatory habit of checking the very latest FTA guidance before you begin any filing season prep. Never ever assume the rules are static. Verify the mechanics before you touch a single spreadsheet. As we wrap up our analysis of these sources, I want to leave you with one final pretty important thought. Are your tax files actually ready for tomorrow's rule changes? If you implement the structured, defensible file we walked through today, and you maintain absolute vigilance over this evolving regime, your answer will be yes. Thank you so much for joining me for this explainer. Stay curious, stay compliant, and I will see you next time.